Today's topic is roadmap to minimizing taxes, and this is the business owner edition. So before I get started, just want to kind of give you a little background about myself. Been an entrepreneur since the age of 14 in various different industries. Got into the accounting and tax side about 10 years ago. But throughout my kind of entrepreneurial journey, have had experience in various different stages. Everything from starting a business to growing a business to selling a business. Along that process, I've seen massive success, and I've also seen many more failures along that way. And so really what my goal and in my passion with our podcast and the things that we're doing and what we're putting on today is to just share some of those experiences that I have. If I can take some of the experiences and things that I've learned along that journey and share it with other business owners, that's really my goal. So where I'm at today, founder and host of the Small Business Tax Savings Podcast. If you are here and a listener, you probably have listened to our podcast at some point. I'm also the creator of the tax minimization program. And then on the back end of all that, we also have a full service accounting firm as well. And I just put a mission there because really what my goal with our podcast, our tax minimization program is just for every business owner to know the strategies that are available to them so that they can pay the least amount in taxes legally possible. And so that's what we do. Everything that you look at, all the content we produce, everything that we're putting out there, that is our goal, to really just bring awareness to business owners so that they know that tax savings are available and tax savings are not just for the ultra rich. So that's what we're going to be talking about today. Just a very quick disclaimer before we get started. Basically, everyone's situation is going to be different. What we discussed today is just a hypothetical scenario, although it's really based on real life situations. It's a hypothetical scenario to erase names and everything else from this. Tax savings that we talk about are based on a marginal rate, which is just an easier way to just present the material. It's also based on rough estimates, so kind of a rough idea of where the tax savings are. In every strategy, everything that we talk about today, it's important that we also set up, understand it, and also fully document various things involved in that strategy. So what we're talking about today, it doesn't mean you just go and move with what we're saying. There's some documentation. We want to make sure that we're doing it correctly, as with all tax strategies. Everything we talk about today will be legal, and we're not going to be talking about illegal stuff. If that's what you're looking for, you're in the wrong place. But with that being said, there's also some documentation and proof that we need to make sure that we're doing to back up and support what we're claiming as business. And then, of course, discuss the situation with your client, with your accountant. If you see something that you really enjoy, just be sure to talk to your professional just to make sure that it does match your specific scenario. So today we're going to be talking about the roadmap to minimizing taxes. I'm super excited about this presentation because I think it's a really good outline of where do we start? Where do we start with? What are our tax issues that we're facing? And what does that path look like to fix those issues? And so that's exactly what we're going to be running through today. So to get started, just want to give you some background. And this is just kind of giving you an idea of what are we basing what we're talking about today? What are we basing the strategies that we're utilizing? And this is what we're basing it off of. Basically, we have a family of 4, a husband and a wife, and 2 children, aged 10 and 14. They run a business, and that business profits $200,000 a year. And it's just a consulting business for other small businesses, and there's no employees. This could be a marketing company. This could be legal, various different things like that. And their current tax scenario is they're paying federal income tax of $15,800, and they're paying self-employment taxes of $23,700 for a total federal taxes of $39,500. We're not going to go into the state side because everyone on here is from a different state. So this is just kind of the scenario. This is what we're starting with. What we're starting with. Again, family of 4, husband and wife, 2 children, aged 10 and 14. They own a business with profit of $200,000. It's important we're talking about profit. We're not talking about sales or revenue. They have a profit. They have a business that's profiting $200,000, and their current federal taxes is $39,500. That is after the standard deduction, child tax credits, things like that. So that's kind of the tax bill that they're facing. So we're going to start out this journey with this family saying, okay, what are we going to do for this family? What are some tax strategies and implementation? How are we going to help minimize or lower this family's taxes? And so when we start this journey, the first thing that this family did was they started listening to the Small Business Tax Savings Podcast. And so if you're not a listener yet, I definitely recommend you go through that, because that is where this family learned about everything we're going to talk about today. They learned about these tax strategies. They understood what tax strategies were meant for them. And that's the starting point. This family also joined our tax minimization program. And we're going to be talking about that at the end too, as well as where they found out, okay, we're understanding these strategies. We understand what's meant for us. Now, how do we implement them? What does that look like? That's where they've learned it. So that's where, when we talk about what this family is doing to minimize their taxes, those are the steps they took. Started listening to the Small Business Tax Savings Podcast, joined the tax minimization program, and actually took tax savings seriously. All right. So before we get started into the actual strategies, I want to talk about this idea of tax planning versus tax paying. Tax planning is something that we do all year long. And it's one of the things, when we look at small business owners, it's one of the number one mistakes that we see small business owners make, failing to plan. When people think of taxes, traditionally, they're going to think of tax preparation and tax filing. But that is simply taking information and sending it up into the federal agency, federal government, the state government. It's taking information and sending it to the government. What my goal is, and what we're going to be talking about today, is that I hope when you hear this word tax, you're thinking tax planning. What can I do throughout the year to make sure I'm paying the least amount in taxes as legally possible? And that's the important thing about tax planning. This is a year-long thing, where tax filing is a once-a-year thing. And the thing about tax filing is that happens after the year's over. And the other problem with tax filing, if we only think about tax filing, is that most of the times, once we're filing our taxes, there is not a ton of strategies that are available to us anymore. Most of planning needs to be done throughout the year prior to the year ending. And then you do your filing, which is, again, just taking that information and sending it up. So if there's one takeaway from today, I want it to be this idea of, when you hear taxes, I want you to think of tax planning. What can I be doing throughout the year? What can I be implementing? What strategies can I be utilizing throughout the year, so that when it comes to year-end filing, I already know that I'm paying the least amount in taxes as legally possible. And to give you this idea of tax planning, I like to look at this as pre-tax and after-tax dollars, as you can see here. And I want to just kind of do a quick story about this idea of pre-tax versus after-tax dollars. So when COVID hit, so many people were forced to go work from home. They were maybe in an office. Now they're working from home. And when you're a W-2 employee, which just means you're working for somebody else, you get your gross wages, and then you get all these taxes taken out. And then whatever is left over is after tax. That's the amount that you go home with. And so those are after tax dollars. And that means that any spending that you do in your household for your work is after tax dollars, because that money's already been taxed by the time it comes to you. And so if you were in COVID, you were working for an employer, they said, okay, we got to go home, you got to work from home. You might have went and bought a desk. You might have went and bought an office chair. You might have, now you're utilizing more heat to heat up the house during the daytime. You're using electricity and internet and all sorts of different things. But as a W-2 employee, you're spending all of those costs using after-tax dollars. You don't get any business deduction for them. Again, you have your gross wages, taxes get taken out, whatever's left over is what is called after-tax dollars, and that's what you're doing the spending on. Now let's flip the switch. As a business owner, that desk you buy, that chair you bought, your home office that you're working in, those utilities, that internet bill, that cell phone bill, these are all potential pre-tax dollars or pre-tax spending. And so as a business owner, we have our sales or our revenue, and then we have all these expenses that go into it. And then whatever is left over is our profit. And that's going to be then your after-tax dollars. That's what you get taxed on, whatever your profit is of your business. So as a business owner, we can turn this typical after-tax spending into pre-tax spending. That office desk, that chair, that home office, that's all spending that we can, instead of paying for it after our money's been taxed, we can turn it into pre-tax spending. And so our goal is always to try to figure out, how can we move more after-tax spending, maybe spending that we're going to do no matter what. How can we turn that into pre-tax spending, get a business deduction for it prior to that money being taxed? And so that's a really good starting point. I feel that people need to understand this idea of after-tax dollars and pre-tax dollars, and why, as a business owner, we are so much more advantaged because we're able to find business purpose to spending that maybe was going to be after tax spending, but now we can turn it into pre-tax spending, get a business deduction for it, and reduce our taxes that way. All right, so let's start diving into the various strategies that we're going to be talking about today. The first strategy is an S corporation. And just to give you a little background about an S corporation is one of the first strategies that we look at with a small business owner, assuming they're hitting certain benchmarks. The S corp starts to make sense once you're hit profit of $50,000 roughly or more. So if you're in that $10,000 in profit, S corp might not make sense yet, but once you start to hit profit of $50,000 or more times than not, an S corporation is going to be a great option for you to help minimize self-employment taxes. And so let's talk about that S corp a little bit. An S corporation is simply a way to be taxed. It's election to be taxed. So you either need to be an LLC or a corporation, and then you just simply elect to be taxed as an S corporation. And how this works is let's say you're a sole proprietorship or a single member LLC. In our story here, we have a family that's just a single member LLC. They have no S corporation. And so they get hit with self-employment taxes on 100% of their business income. Self-employment taxes is roughly 15.3%. So on all 100% of our family's business income, they get hit with self-employment taxes on. But by simply electing to be taxed as an S corporation, now they're still going to remain an LLC, but now we're changing the aspect a little bit. And we look at this from a tax savings. With an S corporation, we need to split our income into two pieces: a reasonable salary for the work that we're doing and dividends or distributions and owner draws. And with an S corporation, that reasonable salary that we take out of the S corporation, so we're going to be a W-2 employee of our own business, that reasonable salary that we take out of that S corporation gets hit with self-employment taxes. But the beauty behind the S corporation is that remaining amount, that amount over and above our reasonable salary that we take as an owner's draw or distribution, just simply by taking money out of the business account into our personal account, we do not get hit with self-employment taxes on. We still pay our normal income tax rate, but we avoid self-employment taxes on anything that's non-salary. So in our family situation here, you'll see that we determined that a reasonable salary was $80,000. Based on the work that the owner was doing within the business, it was a reasonable salary to pay him $80,000 a year. Now, if you remember, their profit was $200,000. So that means that there's $120,000 in additional income from this business that they're just going to take as a dividend, distribution, owner's draw that's going to avoid self-employment taxes. And so this one, when we're looking at a new business owner, or a business that's, again, over that roughly $50,000 or more in profit, one of the first steps we look at is, do you qualify for an S corporation, and does an S corporation make sense? So our family here, S corporation definitely made sense. They're profiting $200,000 a year. We determined that $80,000 is a reasonable salary for them. So we're going to avoid self-employment taxes on roughly $120,000, that remaining amount. And by doing that, it's going to provide tax savings of $10,847. So this is a great example and a great starting point, a great foundation on how we can start to save taxes for this family. Now, the important thing to also note is that this is savings that is done each and every year. This isn't just a once a year thing. This savings will happen over and over and over now that they're being taxed as an S corporation. Let's go to the next strategy. Now that we have said, okay, S corporation makes sense for this family, now we're also going to implement what we call an accountable plan. And an accountable plan is basically just a fancy word for reimbursement. It's a way for the business to reimburse the owner for items paid personally. So think of things like a home office, utilities, cell phone, automobile, things like that. And again, an accountable plan is simply something that you put a document in place, put it on file, and then you make your regular reimbursements to the owner for the business related items that they may be paid for personally. So this is a great if you have a business and personal mix. Let's say you have an automobile that's business and personal mix. Or in this scenario that we're going to talk about right here, we have a home office. A home office, we obviously live in that home, so we have some home office expenses, or we have some personal expenses, and we have some business. That's a business and personal mix. We're going to utilize and implement an accountable plan to help reimburse us ourselves personally for the business use of these various items. So in this example, we took a 2,000 square foot house. We're living in a 2,000 square foot house. The office portion was 180 square feet. So roughly 9% of this house was business related. That office that's used exclusively for the business. And so there was expenses as part of that. There was mortgage interest, property taxes, home insurance, utilities, lawn care, some repairs, minor repairs, some cleaning. These were all expenses that were being done, paid for personally. But now as a business and by implementing an accountable plan, we're able to reimburse ourselves from the business, get a business deduction, no income tax on that reimbursement. We're able to reimburse ourselves for the home office portion and get a deduction for that on the business side. Again, we're only taking all these total expenses, only 9% of that is going to be business related, because we have to find out what percentage of our home is business related. And that's where that initial calculation, that 180 divided by 2,000. And so by implementing an accountable plan, we provided savings of $391. Now, again, these are all hypothetical numbers. And I wanted to be conservative when we go through this presentation together. I want to be conservative with these numbers and say, okay, let's not go overboard. Let's be in the middle. Some people are going to be much more than this. Some people might be a little bit less than this. Either way, we want to just at least get some numbers down, because I feel like when you see the tax savings and options available, it just helps make sense of kind of what is available out there. Okay. And so just continuing this idea of this accountable plan, there was other things, the personal use of automobile. So there was a cell phone, internet, travel, tolls, parking, meals, various other things. So again, the idea of an accountable plan is if there's anything that's business and personal mix, it's a way for the business to reimburse you for it. Or if there's something that you accidentally was 100% business related, but you accidentally paid for personally, this is a great way to get a reimbursement for that. So in this case, they had a personal use of an automobile. They drove roughly 6,200 miles on their personal automobile for the business related. And so in this case, we use the mileage, but you could also look at an actual, you could look at depreciation, gas, repairs, and take a business portion of that. But for their situation, the mileage made the most sense. So we took 58.5 cents, multiplied it by the amount of business miles that they had, and that's where we get a deduction for that. We also utilize the home office to help maximize this deduction. So traditionally, if you go from your home to an office, that is considered a commute. That is not a deductible trip. But now, if your commute is really from your bedroom to your home office, anytime you leave your home office to go anywhere else related to the business, now we have a business deduction. So that's why another strategy that now that we're utilizing a home office, let's expand that even further. So we're utilizing that home office, but now we're also increasing our mileage, because every time we're leaving that home office for business related items, we now have a deductible trip instead of what could have been typically considered a commute. There's also a cell phone bill that they had. It was $1,800 for the year. They're going to say 80% of that's related to the business, so a total of $1,400. And then there was various other costs, some parking, some travel that they had, miscellaneous items that were able to deduct for $1,200. And so by utilizing the accountable plan in this situation, remember we already did the home office. Here is some more information from that accountable plan. We were able to provide tax savings of just under $1,400 utilizing this portion of the accountable plan. All right, so let's go into meal expenses. The biggest thing we talk about meals is finding a business purpose for regular everyday meals that we're going to be doing. And the key thing here is that for 2022, meals are 100% deductible. Meals at restaurants are 100% deductible. Traditionally, that's going to be 50% deductible. And the best strategy that I talk to clients when we're talking about meals is, can we find a business purpose for this meeting? Are we meeting a friend? Are we meeting a family member? But do they happen to be a client of ours, or a future client of ours, or a potential employee of ours? Can we find a business purpose for some of these meetings that we may be doing anyways? Then we can get a business deduction for it. So we talked to our family here. We looked at some of the business meetings and everything that they had over meals, and they had we found some expenses that we can pull out of that, which was $1,820, and the savings here was just about $400 by, again, looking at this idea of maximizing meals. They might go out to lunch with a friend of theirs or a family member, and they're going to do that no matter what. But instead of thinking of that and using after-tax dollars for that, they were able to plan it around a business meeting that they were going to have with that person anyways. So now they took a typical after-tax spending and moved it to pre-tax spending. Again, we always want to be thinking, is there a business purpose for what we're spending? If so, let's run it through the business so we can get a deduction for it. Okay, so travel. And this is one area that I feel is one of the most missed areas that we see small business owners miss. And basically, if you organize business trips around planned travel, maybe personal travel, there is a possibility that you could have that entire trip deductible. So we always say, whenever you are doing any kind of organization or planning some travel, can we mix business into that? Is there a client that we could be visiting? Is there a conference going on? And we see this a lot. They might have a conference in Hawaii. We're going to go to that conference in Hawaii, but in the meantime, we're going to be doing some personal things on the side. And the biggest thing here is that in order for that travel to be considered a business expense, the majority of the day has to be spent on business. And when the IRS looks at it a day, they look at it as in 8 hours. So the majority of the day would be 4 hours and 1 minute. So if we spend 4 hours and 1 minute on business related, whether that's visiting a client, visiting a rental property, attending a conference, that's considered a business day. The IRS does not care what we do after that. We can go to the beach, we can go explore the Grand Canyon, do whatever we want to do, as long as the majority of that day was considered business. Now we have that idea of the majority was spent on business. Now that's a business day. And so this includes things like hotel, airplane, valet, tips, rental cars, tolls, taxis, Ubers, Airbnbs. All of these are 100% business write-offs if it's a business trip. And so that's why we always say, get strategic with your planning. Get strategic with when you're doing your trips and finding a business purpose for that. So this specific family that we were working with, they took 3 trips throughout the year, and they were able to spend the majority of the time on business on those trips. So they planned a conference, they visited a client, and they also visited a vendor of theirs. And around that trip, they planned business. It was a majority business trip, and they were able to then take that deduction and fully deduct it. So the total cost that they had was about $6,000 they spent on this travel. Again, before meeting and before listening to these strategies, they didn't think about this idea of spending when they're looking at traveling. They didn't think of this idea of finding a business purpose. They just said, "Oh, we're going to go to DC for the weekend, or we're going to go down to Colorado for the weekend." They didn't think, "Hey, is there some conference? Is there something that we can plan around this? Can we plan a client meeting? Can we turn business into this and now get a deduction for it?" Now, for everybody out there, I will say spouses sometimes don't like this. Do not plan every family trip around a conference or something where you are going to be spending the majority, at least 4 hours and a minute of the days on business. Don't do it every time. I'll tell you that we've gotten kickback a lot of times when we have a spouse and a husband and a wife on a meeting, and we talk about the strategy, and they're like, we're not doing this. So just something to consider. You have to be sure you're documenting this. What is the business purpose? What are the hours out there? You can't just fly to Hawaii and do an online conference, listen to me on a webinar and say, this is a business trip, listening online. That doesn't work. So we need to make sure that we're documenting and have business purpose for it where it makes sense. But otherwise, this planning can really add some expenses into the business line. Again, this is spending that we might have done anyways. We might have gone to Colorado, but now we found a business purpose for it. We made a business purpose for that, wrapped business around that trip. Now, instead of using after-tax dollars on that trip to Colorado, now we're finding a business purpose using pre-tax dollars. So in this case, the family found about $6,000 in trip expenses, and that saved them a little over $1,300 in tax savings. All right. Hiring their kids. Now, you remember we talked about initially their kids were 10 and 14. And this strategy is one of my favorite strategies, and I think one of the most often missed strategies of business owners that have children. This idea of hiring your kids in your business is a way to get a business deduction. Your kids potentially pay no income tax on that income, and you get a business deduction for it. Again, you're going to be supporting your children, whether that's basketball camps or they're going to theme parks with their friends. You're going to be supporting your children usually with after-tax dollars. What a beautiful way. What a great way to turn after-tax spending that you're going to do anyways into pre-tax spending. Get a business deduction for it. They pay no income taxes from it, and you're just turning after-tax dollars into pre-tax dollars. So in our situation, they had a 10-year-old and a 14-year-old. The 10-year-old, they looked at everything that they were doing and the type of work that they were doing and decided to pay them $5,200. And the 14-year-old, they paid $12,000. Now it's key when we're looking at this. They must be doing actual work for the business. They must be working at a reasonable rate, and they must have clear documentation along with agreements to help back this up. But a lot of people come to me, they might be a law firm, and they say, Mike, I'm a law firm. What can my 10 and 14-year-old possibly do in a law firm? And I say, get creative. Think of things they can do. Could they be shredding papers? Could they be stuffing envelopes for a marketing mailer campaign that you're doing? Could they be setting up social media for your law firm? And they'll say, well, we don't do social media. We have so much referral work. We don't need social media. And I go back to it and say, but what if you could get a business deduction? Your kids pay no income tax on that for spending that you're going to do anyways. Why not just set up some social media for your business? Whether you utilize it or not, we're finding a real purpose that they can help in your business. And so I just want to say, if this is something that you're just like, I don't know what they're going to do in my business, you need to dig deeper. If you have children over the ages of 7, under the age of 18, this is something that should be being used. And I'm going to go a little bit deeper and to talk about how we even bonus this strategy on top of it. Basically, you get a business deduction, and if the child's income is under just around 13,000, which is the standard deduction, 12,950, if set up properly, they're going to pay no income taxes on the federal level for this. Now, there's a couple key things we need to think about. If you're paying this out of a sole proprietorship or a single member LLC, there is no Social Security that you have to pay on these wages that you're paying your children. There's no Medicare, there's no federal unemployment or anything like that you have to pay for your children. So if you're set up as a sole proprietorship, single member LLC, maybe a partnership that's just spouse owned, and you're hiring your own children. The key thing here is that you're hiring your direct dependent own children in your business. If you're operating as an entity like that, you don't have to withhold Social Security, you don't have to hold Medicare, federal unemployment. And if you pay them under 12,950, there's going to be no income tax that we need to withhold as well. If you go over that amount, then it comes into an issue there. But the problem is remember at the beginning, our family decided to do an S corporation to help save on self-employment taxes. And so since we set up an S corporation, technically they're not direct dependents of the business owners anymore because it's an S corporation, it's an entity. And so there's a workaround that we call a family management company. And basically what happens is the S corporation is going to hire this family management company, which is going to be a sole proprietorship, single member LLC for, let's just say, advertising work. And then that family management company is going to hire the children out of that sole proprietorship just to avoid that Social Security, Medicare, federal unemployment taxes. Now you can pay them out of the S corporation. You're just going to get hit with self-employment taxes, which is basically Social Security and Medicare. But there's still going to be no income tax on the first 12,950. But we always recommend this kind of workaround where we use a family management company so we can avoid also those FICA taxes on it as well. Again, this is a business deduction and tax-free income to children. Now, one of my favorite combinations on this, and we dive deep into this in the tax minimization program, so don't want to go too far with it, but just want to give kind of surface level information on this, is to combo this with a Roth IRA. If you have earned income, if your children have earned income, they can fund a Roth IRA. And because there is no taxes, there's no disadvantage to Roth. Many times the problem with a Roth is that you don't get a tax deduction for funding it. But we went through an example. I think it was like a 10-year-old that we did this scenario with. They funded the Roth IRA one time for $6,000 when they were 10 years old or 8 years old or something like that. And by the time they hit 60, that $6,000 Roth IRA turned into just about $1 million, all withdrawals tax-free because it's a Roth IRA. Now imagine magnifying that. Let's say for 10, 11, 12, 13, 14, we're going to utilize a Roth IRA. This just explodes. This just makes this type of strategy even better. So again, we want to be thinking of ways, if we're going to be paying our children anyways, we're going to be paying for things, how can we take that after-tax spending that we typically would do and turn it into pre-tax spending? This family did exactly that. They utilized a family management company. They paid their 10-year-old $5,200 and their 12-year-old $12,000. And that provided them savings, tax savings of just under $3,800. Not to mention if they did the Roth IRA, the tax savings and potential around all that, beautiful stuff. The other cool thing about hiring your kids is you're starting to get them introduced into the business that you're running. Now, that can be a good thing or a bad thing. They might say, well, I never want to do what mom and dad do because I don't like their business. Great. Well, at least they found that out at a young age and they can go do aspirations for what they want to do other than that. Or if you plan to have them take over that business, get them started early. Regardless, it's a good learning experience. They're working for money. They have this idea of working for money. So take the tax savings out of it. There's even some greater opportunities when you look at those things as well. Excuse me. Okay. 14-day home rental. This is also called the Augusta rule, based on the Masters tournament in Augusta, Georgia. And basically what was happening in this situation is people that lived around the Masters tournament, or think of Super Bowl, even if you live in the city of a Super Bowl, they were able to rent out their houses for a lot of money because there's so many people and it's kind of a weird area. And they were able to rent out their house for a lot of money, but they were only renting them for like a week whenever this Masters tournament was going on. And they were forced to then have to pay rental taxes on that week rental that they had. And the IRS kind of stepped in and said, that's not rental income. That's not the point of rental income. This is just a one short time, once a year type thing. We're going to consider that tax-free income. And so basically what the law says is if you rent your personal residence for 14 days or less, you don't have to pay income tax on that income. And so we said, okay, let's turn this around and let's think about this as a business owner. How can we rent our personal residence to our home for business meetings, maybe corporate meetings, annual meetings, board meetings? How can we rent our home to our business, get a business deduction, and pay no income tax on that money coming in, assuming we're under 14 days or less? And so that's kind of this idea of the 14-day home rental, or Augusta rule, that some people call it. You must have a legitimate qualifying occasion. So this could be, again, meeting with a client. This could be having a monthly board of directors meeting. Board of directors might be some family members too. Who knows? I don't know who your board of directors are. This might be having clients stay over. This might be having team members stay over, or doing some masterminding at your house. So you must have a qualifying occasion. You must be rented out for a reasonable rate. So if you're having a board meeting there, what is a typical board meeting at a shared space rent out for a day? Gather some of that information, make sure you're doing a reasonable rate, and have the necessary documents, a rental agreement, those types of things to help support and back that up. Again, this is a business expense, fully deductible business expense, and tax-free income to you if your total rental days are 14 days or less. So for our scenario here that we're talking, our family, they rented out their home to their business for client and corporate meetings that they had. They did 12 of these. They kind of did some research around and say, okay, what would it be worth, or what would the cost be to have one of these meetings for a full day and everything else? And they determined that $750 was that reasonable rate for a similar type of space as what they utilized in their home for this scenario. So by doing this, just under $2,000 in tax savings that they saved by implementing this 14-day home rental rule. All right, let's look at a capitalization policy. And again, if you guys have questions, feel free to send them over. But the idea of a capitalization policy is simply just something that we put in place. We fill it out, put it on file some things with our tax returns when we file that. But basically just says that we're setting a limit, saying that any purchase of an asset or expense that we have that's under this dollar amount, we're going to expense immediately. We don't have to depreciate it. We don't have to do anything like that. Anything over that amount, we're going to depreciate, capitalize, and depreciate it. And so this is a policy we put in place. The safe harbor that the IRS allows is $2,500. So if you have one item that costs $2,500 or less, if you have a capitalization policy in place, they say, yep, you can expense that immediately without having to worry about depreciation, putting it on your balance sheet, or anything like that. So we always recommend every business owner have a capitalization policy in place, because not only does this just make things easier, you don't have as much reporting to do. You don't have to take care of that balance sheet and making sure you're doing all the depreciation correctly. If you have an item, single item that's $2,500 or less, utilize a capitalization policy to expense it immediately. So our client here, they went out and bought a new computer, a new TV for their office, a new desk and chair for their office, all these types of items they were able to expense immediately because they had a capitalization policy in place. Now, the key thing here too is that it allows you to, when you go to sell these items, they're not a listed property. But again, we just want to make sure that they want to have the right things in place for these items. So by making all these purchases through the business, finding that business purpose for it, they had tax savings of $836. Retirement plan. So this one is going to be very different from business owner to business owner based on your scenario. Do you have other employees or not? What is your purpose and idea behind a retirement plan? And so on our podcast, within our tax minimization program, we dive deep into all the different types of retirement plans. We dive deep into what you should be thinking about when you're looking at bringing a retirement plan into your business. And we talk about advanced retirement plans. How can we even fund way more than even, what the cap is that you're seeing on the screen right now? So the thing with retirement plans is that we want to make sure that you're looking at one that's the right fit for you. It's not going to be, again, and that's with all these strategies, it's not the same fit or the right fit for every person the same way. But in this situation, they really had kind of two options. Remember, they have no employees, so they could do a SEP IRA or a solo 401k is kind of what they were looking at. Now, they could even do a traditional IRA if they wanted to, but they said, we want to max out our retirement as much as possible. So we said, okay, let's look at how we max that out. Now, remember, we gave them a salary of $80,000. With a SEP IRA, you're limited to 25% of your salary. So in their scenario, 25% of their salary, $80,000, is $20,000. So if we don't the SEP IRA route, the max they could put into retirement would be $20,000, which is why you'll see here we implemented for them a solo 401k. And traditionally, for those small business owners that have no employees that really want to max retirement accounts, we're going to look at a solo 401k. So as an employee, you can put up to $19,500 into the account, which they did, and then the employer can match up to 25% of their salary. So they were able to put $39,500 into a retirement account through the business. And on the employee side, there also is a Roth option. So if you wanted to put money into a Roth option, there's a really cool way that you can do that on the employee contribution side, again, up to $19,500. So we implemented in them a solo 401k into their business, this saving, just under $8,700 for them. Health strategies. This is, again, I don't want to dive too deep into these health strategies because they can get way different depending on the scenario, but we're talking about our family of four here and what options are available for them. So there's kind of two things that we did with them. We did health insurance, made sure that they took care of the health insurance deduction, and then we also maxed an HSA. We could have implemented a medical expense reimbursement plan, but did not because they didn't have high medical costs in their situation. So let's talk about that first one, self-employed health insurance deduction. Now that this family is set up as an S corporation, we need to make sure that we're doing the self-employed health insurance correctly. With an S corporation, you basically run that through the S corporation, through the business. You're going to end up taking a deduction for it on the business. You're going to add it to the W-2, so it's going to count as that reasonable salary that we're paying them. And then we're going to take the deduction again on the personal side. So just know, if you're set up as an S corporation and you want to take the self-employed health insurance deduction, there's just a few steps you have to take to make sure you're doing it correctly. So we set that up as $1,000 a month for their premiums, full business deduction for that. Then we also set up a health savings account. This is an area that this is not just for business owners. This is for W-2 employees, everything in there. But this health savings account is something that we recommend everybody max out as much as possible, because it's one of the only tools, or one of the few tools, that the IRS has where you get a deduction going in and you have tax-free growth and tax-free withdrawals if you use it for qualified medical expenses. Now, we have a lot of people that come to me and say, Mike, I'm healthy. I don't need qualified. I don't have any qualified medical expenses. And I say, well, you know what? At some point you will, whether that's when you're 70 years old, some point you will have medical costs, and you can utilize this type of account and utilize it almost as like a retirement plan. But the beauty behind it is that it's like a Roth account where you get withdrawals tax-free, but you also get a deduction going in. So that's why I say it's one of the very few options out there where you get a tax deduction going in, and your withdrawals are tax-free if you're using them for qualified medical expenses. So along with them and every other client that we have, I said maximize your health savings account. Let's take advantage of that puppy. Now, if they had high medical costs, they could have implemented a MERP or a medical expense reimbursement plan where they can also get a business deduction for the medical expenses that they have if they have high medical costs. But it's a little bit more of a complex scenario. They didn't have high medical costs. So we didn't look at that. All we did was simply look at self-employed health insurance, making sure that we're doing it right with an S corporation and the health savings account. And this provided savings of just over $4,200 for them. All right. We also then, at the end of the year, looked at some year-end tax strategies for them. So, some things that we talk about, if they're a cash basis taxpayer, which most small businesses typically are going to be taxpayers. And so what they did is they prepaid for some of their rent for their business. They paid for January and February in December, which means that they got a deduction for it by prepaying it. They got a deduction for it in December, but obviously they missed out on that deduction in January and February because they prepaid for it. And they also had a large client of theirs that owed them $7,000. And they said, hey, instead of paying us here in December and us having to pay taxes in December, can you hold off? We're going to send your invoice on January 1st, make the payment after the new year, and we'll be set there. So just a couple of timing differences that they adjusted at year-end strategies by prepaying rent and slowing down the billing of one of their clients. They saved just under $2,000 in taxes in that tax year. So that's something that year-end tax strategies, we're just going to kind of evaluate where are you at. Do you need some expenses? Do you need to shift some income into a future year? Other clients is kind of the opposite. They're saying, hey, we're running at a loss. I'm going to try to get as much income in this year. I'm going to try to get clients to prepay us so I can offset some of that loss. And then that's going to be income that I don't have to worry about next year. So whatever situation is, we want to be looking at year-end strategies and just make sure we're taking advantage of everything. Because remember, once the clock hits 12/31, most of those strategies go out the door. There's still some tax strategies available after year end, but most go out the door at that point. All right, so credit card statement. The next thing that we did with this client is we went through their personal credit card statement to see if there was any additional expenses that were business related, but maybe were missed. Again, this is really driving home the idea of after tax versus pre-tax dollars. We want to look to see through our spending, was there a business purpose for some spending that we maybe did? So they just kind of went through their credit card statement on their personal side, said, oh, this was business related. We accidentally put it here. And they kind of just did a siphoning of that and said, oh, yeah, we did have a business purpose here. We met with Aunt Sally, but we were talking about our revamp of our business strategy and our marketing campaign with her. We shouldn't have put that on the personal side. That should have been a business expense. So they kind of went into their credit card statement to find those types of items, found about $2,400 in savings there, utilized the accountable plan to reimburse it, and that provided $528 in tax savings. So this is really, a really quick rundown of these tax strategies that we want to implement. Again, we're always thinking about this after tax versus pre-tax dollars. Same thing with hiring your kids. We're going to be supporting our kids. We're going to be paying for things for our kids anyways. Why not get a business deduction for it and turn an after-tax spending into pre-tax spending? That is much of what we're talking about. We're talking about tax strategies. Now, the other thing that they did is they did a bookkeeping cleanup. They spent a lot of time getting control of their bookkeeping. This is something that is so important. So many people think, I don't need to do bookkeeping. I'm just a small carpet installer and I don't have that much to bookkeep, and I'll just worry about it year end. Then it piles up. They have no clue how their business is doing. So we talked with this family and said, okay, let's get control of your bookkeeping. Easy step to do. Let's set up a cloud-based accounting system that's going to connect your bank feeds. You bank at Chase. You just go into this cloud-based software, connect your bank account to this software. We recommend a software called Xero, but they connected their bank account to the software and all those transactions downloaded. So anytime they went to Home Depot, anytime they went to lunch and did various things, those transactions all flow through to their accounting software, and then they just had to code them. So they went through monthly and coded those transactions to their respective accounts. And really what this client did, they utilized these financials to analyze how the business was doing, how various marketing efforts were going. If they did some marketing plan in February, how did that do in March and April? So by getting a control, getting a handle on their bookkeeping, they were able to analyze that income statement, analyze their balance sheet. And the other key thing is they found a bunch of cost cutting opportunities. They noticed when they were doing this, they would analyze their income statement and see the software expense. They're like, what are we spending $1,200 a month on software for? Drill down into it and see, oh, here's a software we haven't used in 3 years that we're still paying monthly for. Oh, here's another one that we're not using, or here's one that we can downgrade because we have, less users or less space that we need. So they were able to, with having a good, clean, accurate set of books, they were able to then start diving into it and saying, okay, here's some things that we can actually cut back on costs. Now, that's not providing a tax savings per se, because your taxes are actually going to go up because you're losing a deduction. But that's where I also want to be very clear when we talk about tax savings. When I talk about tax savings, I'm not saying just go buy things that you don't need. Complete opposite. We're saying let's look at that spending that you're going to do anyways, and let's try to find a business purpose for those types of items. If you can reduce costs, by all means, that's going to give you a much better reward than reducing taxes. If you're paying $1,000 a month for something that you don't even use, you're going to get a much better by getting that $1,000 back than by getting $1,000 tax deduction for it. So keep that in mind when we talk about this. But by killing up their bookkeeping, doing this, it just led to reduced stress as he knew how the business was performing on a regular basis. It made tax season super easy. The 1231 hit and all of a sudden taxes were done. They had the information already completed over their tax person, made tax season super easy. So it just is a great way to help reduce that stress. So what is stress savings? Endless. No price you can say on being able to have that comfort as a business owner, saying, I feel like I know I've got my tax savings done. I've done my planning. I've looked through everything. I've got my books on order. That stress off your back, knowing that things are just taken care of, things are running good, can be so helpful. So as kind of a wrap up to everything we talked about here and these strategies talked about, this is just starting. We're just kind of scratching the surface. This is just getting started with the tax saving opportunities. And it seems like they implement something new after each monthly group training that we do in our tax minimization program. So anytime they're constantly implementing new things, and they haven't taken advantage of every option or even maximized every opportunity. As I talked about, this is a conservative approach of strategies that they're utilizing. There's so much more that they can go. The key thing with tax planning is we're constantly revisiting it. This is not a set it and forget it type opportunity. This is something that we're constantly revisiting every year, maybe a couple times throughout the year. We're saying, okay, is there any new strategies we could think about? Or, hey, my income jumped up into a new level. What tax strategies are available there? Or maybe, it's just a tax strategy we didn't think we were going to utilize. Our kid was 5 years old. We're like, can't hire 5 years old, but now he's 7. So now we can hire them. And so we're always constantly revisiting our tax strategies. We're implementing some. Sometimes we might not implement them in a year based on the situation, but it's got to be something that we're fluidly and actively looking at and implementing. And so if they start to add employees to the business, there's more planning opportunities around that. If their income spikes up to $250,000 or more, it would open up the door to some advanced planning. If they start to buy some real estate, there'd be some planning around that. If they were to sell the business, or maybe they bought Bitcoin at a very low price and it's appreciated in value really high and they have a big gain on that, there's some advanced planning around that. So again, what we talked about today is really just kind of scratching the surfaces, but also providing so much in tax savings. And so I want to just stress this, that this is not all of it. This is not just a set it and done. And I've done all that. Okay, I'm good to go. We're constantly revisiting. We're constantly looking at new strategies. We're re-implementing them, digging for more ways that we can pay the least amount of taxes as legally possible. And again, if you hit certain income levels or certain life situations, selling a highly appreciated asset, there may be even more planning over and above it on those as well. So let's kind of look through, what did we talk about? S corporation, $10,000 in savings. Home office, $400 in savings. Accountable plan, $1,400 in savings. Meals, $400. Travel, $1,400. Hiring our kids, $3,800. Again, these are just tax savings that we're looking at here. There is so much more value even over and above these, as well as this idea of this is pretty conservative. Many of these strategies could be implemented, could have been done higher based on the situation. We talked about the Augusta rule, 14-day home rental, buying equipment in the business, utilizing a capitalization policy, setting up a retirement plan, as much advantage of healthcare options out there as available, doing some year-end planning, going through our credit card. Again, this kind of goes in with accountable plan, but finding those items that, hey, they had a business purpose for it and we could utilize it there. So when we look at kind of cumulative everything, we have stress savings by moving into a bookkeeping program, feeling very confident about where we're at there, stress savings there. And then, again, rough idea of total savings that we have, just over $36,000 utilizing all these types of strategies. So we put this webinar on is just, we want to get this brain thing. Again, if you walk away with anything today, it's when I think of tax, I'm thinking tax planning, not tax filing. Tax filing is something we got to do. It's required by law, but we're going to do that after we've done all the planning for what we're going to save in taxes to begin with. So I want to say, make this the year that you pay the least amount in taxes and reduce your stress. And I kind of asked this question to people that I first talk with is, what tax strategies are you currently utilizing? Put them in the chat, put them in the Q&A, hit us up. Let us know what strategies you're currently utilizing and how often are you revisiting your tax minimization strategy? How many times are you revisiting these strategies and say, can we add a little bit more of that? Can we tweak this? Can we add this strategy? Can we remove this one? Looking into that. I hope by what we talked about today that it is clear that tax planning is not just for the rich. Whether you're making $10,000 a year or $1 million a year, there are tax strategies available for you. Much of what we talked about here can be utilized at any income level. Tax planning is something we should constantly be revisiting and adding to. This, again, is not a set it and forget it type activity. And we say always be learning, always be implementing, and thus you will always be saving. It's important when we look at these tax strategies that we're making sure we're doing them correctly. We need to make sure that we're doing these things correctly, because setting up an accountable plan is great, but if we don't actually set the accountable plan up, or we go to hire our kids and we're not setting up those documents, that's when it can come back to bite us. So these are all valid strategies as long as we're setting everything up correctly. So I want to talk a little bit about our tax minimization program. This is where we take that next step up. And this is where we have training on it. We have a library of tax strategies, implementation guides, videos, downloads. We show you how to, we train you about all of these strategies. We show you how to implement them. We have supporting documents to help you implement it, and everything all within our tax minimization program. Those are all of our content modules. We also have a stress-free bookkeeping training program. So we have 12 modules right now on the tax saving side, and then we have our stress-free bookkeeping training side, and we also have a few bonuses. You have unlimited Ask a Pro email questions, which basically means you have access to our team to ask those general accounting questions that you have. We kind of think of it as like having an accountant in your back pocket. Can I deduct this in the business? What do I need to document if I want to deduct this in my business? We're on that team with you to go through those items. That's included in our tax minimization program. Access to a private Facebook group where you're collaborating with other business owners, have access to our team through there as well. We also do monthly group training sessions. This is where we deep dive into specific tax strategies. We do this once a month where we deep dive into a specific tax strategy, just again, to help open up that door of saying, oh, here's a strategy that maybe I wasn't thinking about. We also have a network of referral professionals. So you need someone to set up a retirement account. We have a great person for you. You have a sales tax item that you want to get talked about. We have someone for you. You want your accounting and taxes done by a professional. We have someone we can send you to. Basically, I think of it as we're kind of that resource for you that we can direct you in the right angle. Just a couple months ago, we had someone saying, "Hey, Mike, I want to fly a private jet with my family for my daughter's wedding or something like that." I was like, "Hey, I know somebody. I got someone for you." So this idea of this referral network, we're going to get you in front of people that if we don't have the answer for you, we're going to get you in front of somebody that does. So now's a great time to join our tax minimization program. You can go to www.taxsavingspodcast.com/tax. It's a great program that has, again, everything we talked about today and so much more. We go through everything step by step, what you need to be doing, along with all these add-ons, partner on your team, unlimited access to our team for those general tax and accounting questions, monthly group trainings, and so much more. We also have our Small Business Tax Savings Summit. This is coming up June 14th and 15th. This is going to be a virtual event, 2-day event. Where we're going to be deep diving into these strategies. Again, digging much further. If you're interested in that, go to taxsavingspodcast.com/tax or /summit. Cool thing about this is here we go. If you want to sign up for it, go to taxsavingspodcast.com/summit. It's a $500 event. If you use a promo code podcast taxes, you get $100 off. And we're also running a special promo for anyone that's been on this webinar. If you sign up for the tax minimization program within the next 4 days, you will get free access to the summit as well. So this is something we don't do too often, but if you sign up for the tax minimization program within the next 4 days, you will get free access to the summit, along with everything within our tax minimization program as well. Some next steps. Join our tax minimization program, which also includes our stress-free bookkeeping training and all the bonuses that we talked about. Go to taxsavingspodcast.com/tax. Check out our podcast. We go through all sorts of tax strategies, all sorts of things. Go to Small Business Tax Savings Podcast. You can find that on any podcasting platform, or you can go to our website and there's a link for it right there too. And also check out our free Facebook group. Just go to Facebook, search Small Business Tax Secrets, answer a few questions, join in there. Our team's in there. We have other business owners like yourself in there learning, just wanting to save on taxes. Everyone's kind of collaborating and sharing ideas. So those are kind of 3 action steps. Join the program, listen to our podcast, or join our free Facebook group.